Hi guys, it's Chad Larson again of MLD Wealth Management Group with Canaccord Genuity. I'm joined here today by Greg Nott, Senior Director and Head of Multi-Asset Investing at Russell Investments. As many of you know, Russell Investments is a global asset manager that offers multi-asset portfolios and services, including advice, investments, and implementation. The firm has over $250 billion in assets under management, and they're headquartered in Seattle, Washington. Russell does have offices globally, over 21 offices providing investment services in some of the world's largest financial institution centers, such as London, Paris, Amsterdam, Sydney, Tokyo, Shanghai, Toronto, and New York. So first, thanks, Greg, for being here today. And we discussed a little bit offline as we're going through this unprecedented social environment and financial environment with Covid-19. Everyone's working from home as much as they can, and social distancing as much as essential services remain open. We've experienced an unprecedented market crash, and we're looking to both our internal and external partners and just creating some dialogue that'll help our clients understand some of the things that have happened, will happen. And offline, we talked briefly about some of the key things that I wanted to talk about today. Is in line, we already know what happened or how it happened, but with the complete dislocation and bifurcation of global markets from pricing, what are some of the interesting opportunities you're seeing with respect to how the Fed has reacted and central banks globally in unprecedented liquidity and quantitative easing, and how that's really setting us up for other opportunities, whether they be tips, inflation, gold, and some of the opportunities you're seeing in investment grade credit. So I'll leave it to you, but I'm interested in your thoughts on those topics.
Well, thanks a lot, Chad, and appreciate this opportunity to speak to you and your clients, and hopefully that yourself and your clients are doing well and staying safe. In terms of some of the market particulars, as you said, we all know kind of what happened. We were hit with two monumental shocks really at the same time. Obviously, one of them being the spread of the COVID-19 into a global pandemic, and at the same time, or virtually at the same time, the oil price war between Saudi Arabia and Russia, which quite frankly is really more of an OPEC versus North America oil battle, quite frankly. And obviously, we've seen the plunge in the oil price as well, which has severe economic impacts for many countries, including Canada. And so this really led to a shutdown of the global economy, and it's led to a massive and extremely quick repricing of risk in the markets. And so the plunge we saw largely in March, from late Feb to late March in the equity markets, was the quickest sell-off into a bear market that we've ever had, worse than 08, worse than the dot-com bubble, worse than 1929 in terms of the speed of the sell-off and how quickly risk assets got repriced as a result of these two shocks. On the other side of that, though, as you mentioned, was really unprecedented reactions from the central banks and from the governments on the fiscal side. So we've had a tremendous monetary response and a tremendous fiscal policy response as well. I would say the magnitude and the speed of this response has been the quickest ever as well. In 2008, we saw a tremendous response from the central banks and the governments, but it was spread out over a 6, 8, 12-month time frame. Here we've seen a tremendous amount of stimulus put into the economies in really just a couple weeks. And I mean, I'm certainly not going to go through all of the programs and what have you individually. There's quite a few of them, but primarily what we've seen central banks cut interest rates to zero or close to zero, including the Bank of Canada. But more important than just interest rate cuts, they've injected a significant amount of liquidity or credit support into the markets. And initially, it was very much more on the short-term funding, overnight funding, repos, money market, commercial paper area of the market. But more recently, they've expanded that out to include a broader array of assets and markets they're supporting. And I'll come back to that in a moment. The reason they did more than just interest rate cuts, and they did a lot of these market liquidity supports, was really that for a period of time in I guess, mid-March, markets were freezing up, especially bond markets. You couldn't trade anything. Even a very, what's normally the most liquid instrument in the world, the 10-year US Treasury bond, it was getting hard to even trade that. And there was a massive amount of selling pressure on government bonds, whether that was from hedge funds needing to delever, or whether that was just margin calls, or that was clients or institutions doing rebalancing. Because we saw so much selling pressure on bonds, there was a lot more sellers than buyers. Markets were freezing up. There was no liquidity. Bid-offer spreads were blowing out, and it was becoming a really ugly situation really fast. So the central banks needed to step in and really kind of unclog the plumbing on the financial system, so to speak. And I'd say they've largely been successful at that. I'd give them pretty good marks for that. Liquidity has improved. You can trade now. Bid-offer spreads have come back down. They're not back to where they were in January or February or 2019, but they're getting closer to that normal range. So the plumbing seems to be working in the markets. Now, certainly there's still a lot of risks out there and a lot of unknowns and a lot of uncertainties. And that's why we've seen the banks actually go a few steps further in the last couple of weeks, including the Bank of Canada, where a week and a half ago, they announced for the first time ever that they're going to be buying, they're going to go into the market and directly buy provincial bonds and investment grade corporate bonds. And the Federal Reserve announced, they were already doing that. But then they announced an additional program where, for again, the first time ever, the Federal Reserve will go in and buy non-investment grade or high yield bonds and high yield ETFs to help support those companies and support those markets. And so that's a massive amount of support for those assets, investment grade credit in Canada and the US, and high yield in the US. Now this, for a moment, on the fiscal side of things, we've seen a tremendous response from governments in terms of stimulus spending and really looking to support their citizens, really. The governments have, by and large around the globe, have been the ones who have decided we need to shelter in place, we need to shut this economy down, we need to try to flatten the curve of this virus. And so if they're telling everyone you can't work, incomes are disappearing, revenues are disappearing, and so it's up to the government really to provide that bridge to the other side where the lockdowns can be lifted and people can go back to work and businesses could start earning revenues again. Otherwise, I mean, they weren't doing that. If they said we've got to shut everything down and then they didn't provide that bridge or that support, then by the time we flatten this curve on the virus and we go back to work, there's going to be no jobs to go back to. Right? There'd be, the level of bankruptcies that we would see would just be off the charts. I think what the governments are doing here in the short term is appropriate, given they're the ones that have forced the shutdown, and we need to ensure that there's still businesses and jobs for people to go back to once this gets lifted. So
Greg, with all of that money printing and support that's coming into the marketplace, is that going to create an inflationary, albeit we saw some adjustments to CPI numbers, obviously being down from February, not having really factored in the price of fuel into the CPI bucket, with oil being historically low down here. How does that set things up kind of more, even out of the short? No one really has a view short term. Jokingly, between industry colleagues, we always used to discuss EBITDA, which was earnings before income tax, depreciation, and amortization, and now we're discussing EBITAC, which is earnings before COVID, C at the end. But how does that set up more medium term? And is there opportunity in some of these inflationary assets like tips or gold or in some of these other asset classes? And is that something where you see positioning strategies get an overweight within Russell's core sleeves?
Right. So I would try to break it out into sort of near-term impacts and longer-term impacts of what we've seen from the response on the fiscal and monetary side. And in the near term, I would say the impacts have been fairly positive. Equities have come off their lows quite a bit. I mean, I think the S&P is up 20-some% from its lows. I mean, still down a lot year to date, but a good rebound off its lows, and we've seen other equity markets likewise. And then in the corporate bond space, investment grade, high yield, we've seen corporate bond spreads come down a lot, which has improved the situation there. And companies do have access to financing. There's a lot of issuance in the corporate bond market, and companies are able to raise cash as needed. So I think in the near term, it's fairly positive. Now, there's still a tough road ahead over the next couple months. We will see absolutely horrendous economic data come out in terms of GDP, inflation, unemployment, and it's going to be tough. And we are going to see defaults rise for sure in terms of companies having to default on their bond obligations or bankruptcies for smaller businesses. So, it is going to be a tough road ahead for the next couple of months, no doubt about it. But the markets are forward-looking. And they are looking into the latter half of 2020 with a view that by that time, as we get into the fall and certainly the winter, the expectation is that the spread of the virus will be more contained, that we will be able to lift these shutdowns, that we will be able to go back to work. And maybe things won't be all the way back to normal, but certainly a lot closer to normal than we are now. And so that's why we've seen markets rally and corporate bonds perform well also here in the near term. And I think a lot of that is due to the actions of the central banks and the fiscal authorities.
Mm-hmm. On that, and I think and I'm not trying to poke you into a singular topic here, but I am. One of the age-old adages in our business is, never fight the Fed, and
right.
trying to take the trade on the other side against, the big papa Fed, who has effectively unlimited amount of money to print. How does that set things up? We saw Bank of America reprice their forecasts for gold as a commodity upwards of $1,000 an ounce to $3,000. And listen, in every market, there's a bear and there's a bull, and there's a right or wrong. Only time has that. But does gold and that exposure to gold inside of the portfolios, and do you feel is going to play a role within our asset allocation?
Yeah, I do, and that gets to sort of the longer term impacts. Like I said, don't fight the Fed is a pretty good truism, quite frankly. And right now they're buying government bonds, they're buying government bonds, but also buying corporate bonds. And that's somewhere in our portfolios, we've added more risk to the portfolios in the credit space, investment grade, and to an extent high yield here in the near term. And so far it's a short period of time, but it's worked, and we think that's going to pay off over the next year or two for us, taking more and more risk on the credit side. But as you go more longer term and in the near term, this massive shock to the economy, this destruction of demand in the short term is disinflationary. Inflation is going to fall, and we actually saw a bit of that today with the economic numbers for Canada come out with inflation down, and that was just that's not taking into account the big drop in oil that we've seen more recently. Mm-hmm. So there's definitely going to be a disinflationary shock here in the near term. Inflation is going to fall. But as we start looking out 2, 3, 4, 5 years from now, then the longer term impacts of what the Fed and the governments, the fiscal authorities have done is much more uncertain in terms of, is this a good thing or a bad thing? And one of the big concerns is this going to be inflationary? Are we going to see a big return of inflation? Are people going to go back to work, and is there a lot of pent-up demand, and are they going to spend a lot of money because they haven't been able to for quite a while. And is the economy really going to ramp up pretty quickly? And if so, all of this stimulus and extremely low negative to zero interest rates ignite some much higher inflation than I think people are used to for the last number of years and may be prepared for. So if that were to occur, then one of the assets that you want to look at, or two of the assets you want to look at, would be gold and inflation-linked bonds, things like TIPS and real return bonds. And so the jury is still out, as you said. Time will tell, and it's certainly not something that I think needs to dominate your portfolio here in the short term, because we do see disinflation. But it's also not a bad entry point when people aren't thinking of inflation. Gold had well, it's rallied now, but it had fallen a little bit back in March, and we use that as an opportunity to add some more gold to our portfolios. Inflation-linked bonds, you look at, when you price an inflation-linked bond, you look at what sort of inflation expectations are built into the price of that bond, the so-called inflation break-evens, and those became extremely low back in March as well, where essentially the market was saying we don't see virtually any inflation for the next 15 years.
Right.
And frankly, I'm willing to take the other side of that.
That risk reward at 15 years.
Exactly.
Yeah,
So we added some inflation-linked bonds to our portfolios as well at that point in time. So right now, our exposure to gold and our exposure to inflation-linked bonds is increasing, but it's still relatively low. As we work through the near-term impacts and we get a better sense of, is this going to be inflationary over the next 2 to 5 years or not, we may potentially even add more to the portfolio.
Great. Greg, I think that's great for today. And I really appreciate you taking the time to speak with me and ultimately our client families that have entrusted us with their funds. Keep your hands on the wheel and keep us safe. And we'll be chatting soon.
Thank you. Thanks a lot, Chad.
Cheers.